one sense, your deal flow is quite easy because you're looking for the top VCs and the top companies at the right stage of their journey. What about what's in it for them? So who comes to you? Is it the VC? Is it the portfolio company? What value do they see in the product?
So it comes back to the issue of dilution. In venture capital, you need to raise sometimes a lot of money to dominate your market or make a successful exit. And on the way, I think the average holding of a founder, at exit is somewhere around 10%. If you sell, even if you sell $1 billion company, compared to the outcome, you have a relatively reduced portion of the upside. And same for early stage investors, right? If you have been in the seed round, you need to follow your money all the way through the exit in order to get, a sizable return. So often it will be anyone who's sensitive to dilution around the table, and that's often founders and their investors.
Particularly the seed ones without deep pockets, I assume. They must love you.
Yes, the seed investors do love us, but all through the value chain. Because even if you are a C round investor, instead of putting, let's say, 100 million, if you get to put 50 for the same outcome, you've doubled your multiple. So really sophisticated investors will bring us in. I see 2/3 to almost 90% of our deal flow comes from the equity investors who are supporting those companies because they don't want to be diluted. They don't want to open the cap table to other investors. Right. So they don't want to share into their best deals.
Yeah.
Sometimes they don't want to price the company. So they're about to sell it to a strategic investor. The last thing they want to do is create a valuation event right before the exit. And so instead of doing an internal convertible round where they have to go to every single person and inform them of the sale, they can just quickly put in place a gross debt round.
Ah, very cool. In that case, so that's the upside.
That's the upside.
Right. What are your terms?
So what's nice is that the marketplace is quite transparent in Europe. It's a senior secured loan. So the best comparison might be with your real estate loan. You take the debt, it's secured on your assets. Then you repay it progressively over 3 to 4 years. Every month you repay interest and principal. The interest rates at the moment, and they've been historically very stable. It's around 8 to 10% spread.
But when you say they've been stable as a spread over the base
rate, exactly.
But then the base rate. Obviously.
Yes, the base rate has changed. But it's like the equity markets. You look at the equity risk premium for equity markets, and in that you would look at the debt spread. So that debt spread hasn't changed a lot. It's not scientifically proven, but my belief is that it's because we are an alternative to equity returns. So if an entrepreneur is thinking either I take equity or I take debt, if I take equity, a VC fund is going to require something like 30-40% return on their investment, and debt is usually 25% of that. So I'll dilute less and I'll pay the 10% to the lender. And that's why the rates have been stable, because the required rate of VC have also been stable over the past 20, 30 years.
Just spill it out for me. What would you normally expect to happen in a rising interest rate environment to the spread?
So 2021, when the rates were zero or negative, the cost of the debt was 8 to 10%. Today it's grown up by 2 to 3%. So it's around 10, 12%. In different markets, in the US where the base rate is higher, there the yields are around 14, 15%. So that's what you would expect to pay. It is expensive. It's more expensive than bank debt. It's more expensive than government subsidized loans, but is 3 to 4 times cheaper than equity on the tagline. And actually, when you look at the dilution, is 8 to 10 times less dilutive.
Yeah, so there's a huge difference between at one end, normal debt provision, and at the other end, equity. And you're coming into this kind of massive gap where there's latitude. You have competitors. Is there a kind of a market standard, or are you a market setter?
I think it's the cost of capital that we all have. If you're a bank, like Silicon Valley Bank was, maybe your price is a little bit cheaper, 1 or 2% cheaper.
Right.
But we're all around the same levels. And what really makes the difference is what type of lenders you want to partner with. What's their DNA? What's your DNA? How are they going to react in the bad moments? Because the difficult, let's call it the difficult moments, it can be due to good things, like the company growing too fast, or the company not growing fast enough. And then you need to have difficult discussions with your lenders, with your equity investors. Who do you want to sit down with in those moments? And I think that's what really determines which lender you go to rather than 0.5% difference. Because ultimately, as an entrepreneur, you're going for an outsized return.
Yes, of course. What about your upside?